Hello, MBA 503 students. This is Professor Hazera sitting in my house in Newport, Rhode Island. In order to help you with some of these chapters, I'm going to make short recordings of the lectures I would have provided in the class anyway, and I'm going to put them up on YouTube. And in an email I will send you, I'll give you how to access it on YouTube. And I do believe that these lectures will help you with your My Business course homework assignments. Now, this particular lecture, I'm making sure that the audio is turned all the way up here. Okay, this particular one is on module chapter 5 of the course, basically. Now, this chapter has a lot of topics on it, but I don't know why they didn't emphasize one topic, which is much more important than all the others, and that is accounting for accounts receivable. We also call it accounting for bad debts. And that's what I would have done tonight. I would have gone over how to account for bad debts. As I told you in an earlier email, I believe that you should read Learning Objective 5 from the chapter, and also look at the Learning Objective 5 e-lectures. I like the e-lectures, but I believe that this might also help you learn the mechanics of accounting for bad debt. Okay, so let's start. What I'm going to start here is I'm going to start with a spreadsheet here. Okay, and on this spreadsheet we have three in this workbook, Excel workbook. We have three spreadsheets. The first one is called Aging, which you should read about in the book. The next one is called Rules for Bad Debts. And the last one, I'm going to give you a quick example on accounting for bad debts. Now, after I finish this lecture, I'm going to actually send you the spreadsheet, so you'll be able to watch the video, look at the formulas, and maybe figure out how all these concepts kind of come together. Okay, now accounting for bad debts, we've said in class a lot of people have asked me, well, you sell many things on credit. What happens if people don't pay? Well, in accounting, we assume that people will pay their accounts receivable. However, based on past performance, based on credit history, let's say, we all have credit ratings, and based on companies' credit experiences with their various customers, they are able to come up with some estimate of the amount of receivables, percentage receivables that will not be collected. Okay, so what I'm going to do here is go over the concept of an aging. And aging, it's an age-old tool. It's a very old tool that companies have traditionally used in order to estimate the amount of accounts, the percentage of their accounts receivable they will not collect. Okay, so let's go over a few things first of all. First, this is just what I said. A basis for measuring bad debt has traditionally been the preparation of an aging. Okay, and here's an aging. What an aging does, as you'll read about in the book, an aging classifies a company's accounts receivable into buckets of time, usually increments of 30 days. Okay, and I'll give you an example. I've got an example coming up, but it's very simple if you think of your credit card. If you pay your credit card before 30 days are up, you're current on your credit card. If you pay your credit card between 30 days, which would make it slightly overdue, and 60 days, it would be a slight credit risk. If you paid your credit card between 60 and 90 days, which is 2 months overdue, between 2 and 3 months overdue, you'd be a heavy credit risk. And if you paid past the 90-day point, they'd probably write your account off, just assume you're not going to pay. Okay, so an assumption in an aging, the key assumption in any aging is that as the amount of time that there's a positive relationship between the amount of time that an account is due or overdue and the probability of non-collection. So as an account gets older and older, the probability that it is uncollectible will go up. Okay, so those are the two aspects of an aging. First of all, it classifies accounts by buckets of time. And I worked for a bankrupt electrical contractor many, many years ago, and I was in charge of accounts receivable, and I could see that you age everybody's account. Okay, now here is an example of an aging. Okay, and I'm assuming that this is an aging for the ABC company as of the beginning of the year. It could be any year, beginning of any year, as of January 1, 2020. So I guess we're dealing in the year 2020. And this aging, I could put the word customer here. Do this. This aging has 4 customers. This company has 4 customers. Now, I'm assuming, and I say amounts owed, I'm assuming that each customer has more than one item they owe for. So, for example, customer A owes a total of $100,000. That's why I put amounts. Customer A owes a total of $100,000, but I'm saying that maybe they have 1,000 different things that they owe $100 on or something like that. So each customer has many items that they owe on. Okay, so anyway, we have 4 customers here, A, B, C, and D. Okay, and these are their total amounts owed. Customer A owes $100,000. Very good credit risk, obviously. We'll get to that in a second. Customer B owes, looks like $500,000. Not too bad of a credit risk, but they're getting a little bit late in their payments. Customer C owes $400,000, and let's say that on average, their payments are 60 to 90 days overdue. And then finally, customer D only owes $10,000. Okay, so we have 4 customers. These are the total amounts that these customers owe are $100,000 for customer A, $500,000 for customer B, $400,000 for customer C, and $10,000 for customer D. Now, the total of these, that is their total. That's the total, the company's total accounts receivable balance. So if you look on the current assets section of the balance sheet, you will see the company has an accounts receivable balance of $1,010,000. So that's what that would be right there. Okay, now we go to that's the amount, those are the total amounts owed. Now we go to the number of days, let's say on average. These are the average days that these customers pay on. So customer A pays current. So on average, customer pays their bills on time. They probably get a sales discount. We're not going to cover sales discount in this course. That would be too much detail at this point. But customer A pays in less than 30 days. So they pay, on average, they pay on time. Customer B pays, they're a little bit, they put off their payment a little bit, but they owe $500,000. So they're probably a valued customer. And they pay between 30 and 60 days. Okay, so that's not too bad. It's overdue, but it's, enough to keep them as a customer. Now, here's what I would worry about in terms of credit quality if I were a company. Customer C owes $400,000, and on average, they're paying between 2 and 3 months. And that would be overdue because paying on time would be actually 30 days. All these other customers are paying paying a little bit overdue. And then finally, customer D is they've got an account, small account, $10,000, and it's 90 days overdue. So it's getting near the 100% uncollectible point. Now, here's the point that the book makes, the e-lectures make, and I'm going to make, that there is a negative, well, let's just say there's a positive relationship between the amount of time that an account is due or overdue, this column right here, as this gets larger here, there's a positive relationship between the amount of time that a customer's account is overdue and the percent. This means percent uncollectible. Our estimate, there's a positive relationship between the amount of time that a customer's account is due and our percentage estimate of the time of the amount that will not be collected. So for customer A, who's basically current, we assume that there's probably, based on collection history of similar customers, let's say, we assume that 1% of the amounts will not be collected because they're a good customer, and that's a pretty small amount. So that's a small percentage of even in real life. So what we're doing here, and I want you to look at this formula here, is we're taking that, to get that 1,000, we're taking the amount due times our estimate of the amount that will not be collected, which is this formula here. Like I said, I'll send you the spreadsheet. Okay, so that's 100,000 times 1% gives you the 1,000 there. Okay, and so we're saying since they're current, we only think there's a 1% probability, or in statistical terms, we expect that $1,000 will not be collected. Okay, now we go to a customer who's not quite as good. Okay, that customer is customer B here. Customer B owes a total of $500,000, which is a large amount. Customer B, they generally pay late, and this would be for a customer that paid between 30 and 60 days late. 3% probability of non-collection is actually pretty good. So maybe this company knows customer B or something like that. But anyway, if you look at the total amount uncollectible that's not collected, we assume it turns out, looking at the formula here, customer B owes $500,000. The amount, the estimated percentage of uncollectible based on experience, maybe with customer B or similar customers, is 3%. So we're assuming that of the $500,000, 15,000 will not be collected. Okay, and the same logic holds true for customers C and D. C owes $400,000. Now this is the customer I would really worry about because they owe $400,000. On average, they're paying between 60 and 90 days, which is 30 days overdue in a sense, because it's a long time overdue, and this would be very generous. We're estimating that if a customer is between 60 and 90 days on average late on their payments, we're assuming that 5% of their accounts will not be collectible. And as I've shown before, if you take the $400,000, which is the total amount they owe on accounts receivable, and multiply it times the 5% estimate that we believe will not be collected, then the amount non-collectible will be, it's just 400,000 times 5%, or the amount non-collectible will be 20,000. The same logic is used for customer D, but notice that for customer D, since they're so overdue, we're saying that there's a 50% chance they won't pay, which means that the value of their account, although it's represented as 10,000 here, is really only half of that, or 5,000. Okay, now once you get the total amounts that will not be collectible, which are gotten by taking the total account times our estimate of non-collectability, once you get all those for all your customers, you sum them up, and you can see the formula here. The formula right there is just the sum of all the estimated amounts that will not be collectible. That amount will give you 41,000. And I want to emphasize that this 41,000 is what you should have on your balance sheet in an account that we call the allowance for doubtful accounts. You notice that I put an acronym here, DA. That does not stand for district attorney. It stands for doubtful accounts. Okay? And all a doubtful accounts is, it's one of these. It's an account. It's the amount by which we doubt a debt will be collected. But if you total them up, that is it's a contra asset account like accumulated depreciation. We call it the allowance for doubtful accounts. Okay, and please keep in mind, you should know that the accounts receivable account has a debit balance, and so here's what it'll look like on the balance sheet. Go down a little bit. This is why I said this is how these two accounts would appear on the balance sheet, and we've seen some of this, and in some of the financial statements you've looked at, they always call it net account receivable. By that they mean your total account receivable less your allowance for doubtful accounts. Okay, so this is what this would appear like in the current asset section of your balance sheet. Your accounts receivable would equal this amount right there. That number there is equal to that number there. So I'll just point out right there. So the total amount of your accounts receivable are the total amounts owed by your 4 customers here. Okay? And then you're going to have an allowance for doubtful accounts. And that allowance for doubtful accounts, it is a calculation. And that calculation is, we'll go up here. There it is right there. It comes from your aging. It comes from the total amount that you estimate that will not be collected. But those two things, this 41,000 should always equal that 41,000. And this account, I should have put this in the spreadsheet, this account has a credit balance. So on your balance sheet, like we said, here's your balance sheet. Okay, so on your balance sheet, what you're going to have in the current section of your accounts receivable is you're going to show accounts receivable with a debit balance of $1,010,000 less an allowance for doubtful accounts of $41,000, which comes from your aging. And then finally, a name I didn't put in here on purpose, but there's an official name that's given to accounts receivable less the allowance for doubtful accounts, and we call that the net realizable value of accounts receivable. So when you see the words in a problem, or in a textbook or similar words, when they ask you for the net value or the net realizable value of accounts receivable, that is officially equal to, we'll do it here, that is really officially equal to, it's a plus sign because of the math, it's equal to the accounts receivable less the allowance for doubtful accounts. That gets you your net realizable value. Now think of the words. This is the amount that you believe that you will realize from collecting your accounts after deducting the amount that will not be collected. It's the net amount of accounts that are realized. Okay, so that's an aging right there. Okay, now I'm going to go over, that's the basics of an aging. Now, if you didn't follow me, you can see the video again. We'll set up some question and answer sessions. I don't think this particular part is very hard. Wait till we get to the example. But at least this video gives you something to go by along with the video lecture. Okay, now let's go over here, and I'm going to go over some of the rules. There's 2 or 3 rules that we use for accounting for bad debts. And these rules, you may say, they're also journal entries. Okay, so I'm going to go over, what I'm going to do is I'm going to go over these 3 rules right here. There's 3 rules right here. They're basically all journal entries in a sense. And I'll go ahead and extend this out. Okay, so these are the 3 events that can impact the accounts receivable and the allowance accounts. There's 3 events that can impact these. Now I've got X's over here, I've got X's there. I'm just giving you the 3 journal entries, and I'll talk a little bit about them. And then after that, we'll go over to our numerical example over here. Okay, so anyways, here's what we got. This presentation of accounts receivable less the allowance for doubtful accounts and your net realizable value right here, net realizable value. This right here, okay, and I'll actually insert an entire row there to separate that out. Okay, but this right here is the same, this is the same accounts that I had on the previous page. So this right here, these right here are the ending point for this worksheet and the starting point for this worksheet. I don't think we really need them here, but I'm just sort of using it as a way to keep your mind on it, let's say. Okay, but there's 3 events that impact, there are 3 events that impact these 2 accounts here. And when you impact those 2 accounts, by default, you also impact their difference, which is 900, which is the net realizable value, 969. Okay, but here's the 3 events that will impact these accounts. And what I'm going to do is I'm just going to talk about these, emphasize some key points, and then I'm going to go through an example on the final spreadsheet, yeah. And that spreadsheet will be our example right there. Okay, so There's three events. The first event, you already know. By now, you should know this entry. These are basically your basic credit sales that you make during the year. So you sell something on credit, and you should know by now that you debit accounts receivable. So you debit accounts receivable, and you credit sales revenue. Okay, now an important part of all these entries is when they're made. Well, this entry, as you know, is made whenever you make a credit sale. So you sell something on credit, you're going to debit accounts receivable and credit sales revenue. That's just the generic entry. You know this entry. You should know this entry by now, but we have to use it in our example. But that's just an entry you should know. Now, the next two entries, I'm going to be very careful with. The next entry, the next two events that can happen, in a sense there are multiple events, but the next two types of events that can happen. Number two, the next event, are the write-offs of accounts receivable. We write off an accounts receivable whenever a customer defaults on an account. That's the event which triggers this entry. When a customer calls you up and says, we're not going to pay, we're leaving town, we're not going to pay, whenever a customer calls up and whenever a default occurs, that they're not going to pay, you must write off that account. By writing off, we say you must take it out of accounts receivable, because you cannot have a number, an amount in accounts receivable which claims that you will collect that account. Accounts receivable, there's two claims in there that a company is saying. They're saying, number one, that somebody owes them something. The second claim is that that person can pay. If that person can no longer pay, out of honesty and good accounting and legality, you've got to write off the account, take it out of accounts receivable. And this is the entry right here. This is the entry that you will make when you write an account, when you take it out of accounts receivable. I'll show you the logic in the example. But the main part is that there is a credit to accounts receivable. There's a credit to accounts receivable. And what that credit does is it basically wipes off, it takes out any amount that was, or it takes out the amount of accounts receivable that is being written off. So in a sense, this credit to accounts receivable offsets any amount in accounts receivable, which could all want to be part of this 1,010,000. It takes out of this 1,010,000 any accounts receivable for which a customer has told you we're not going to pay. So this entry is made throughout the year. You know, every business consistently has customers that will not pay. So whenever a customer says, we will not pay, this is the entry you make. That's the entry that's made. And remember, there's only three entries that are going to go into these two accounts. Credit sales, which you know, this write-off entry right here, which is done throughout the year. Both these entries are done throughout the year. You sell things throughout the year, so you record credit sales. Throughout the year, people default, so you write off accounts receivable with a credit to the accounts receivable and a debit to the allowance for doubtful accounts. Now, when you make this entry, keep in mind that since you're crediting accounts receivable, you're going to reduce accounts receivable with this credit. So that credit reduces accounts receivable. Also keep in mind that since you're debiting the allowance account and the allowance account has a credit balance because it's a contra asset account, you're reducing that account also. So this entry right here, and I'm going to sort of make a notation. I'm going to say entry reduces both accounts receivable and the allowance. I'm just doing that, and I'm going to not just put it in red, I'm going to put it in big letters here. Put it in big letters here and even bold it. Make it bold. This entry here reduces both your accounts receivable, because any asset goes down with a credit. You're reducing both your accounts receivable and your allowance account. So as you write off accounts, your accounts receivable account is going to be reduced. We'll look at that next time. But correspondingly, you're also going to be reducing your allowance for doubtful accounts. So as you make this entry right here, this amount here is going to go down. And the big question that people always ask me is, well, if you write off enough accounts, if you keep writing off enough accounts, won't you run out of allowance? So if we wrote off more than $41,000 in allowance accounts, you would run out of allowance. Okay? And that's why we have our third entry. Our third entry is a year-end adjusting entry. This is entry number 3. That is entry number 3. We only do it once a year. Whereas we do these first 2 entries whenever we have a credit sale for number 1 and whenever we have default for number 2. So we do those throughout the year. The last entry, I can't emphasize enough that the last entry is only done one time per year. Okay, so I don't know how well I wrote this, but this last entry here is done. This last entry is done one time per year. It's supposed to say it's done one. It's a 1 year, one end of year adjusting entry. You only do it one time every year. And the purpose of this entry, is to do 2 things. First of all, you have to replenish your allowance account. Just like I said, if you make enough debits to the allowance account, pretty soon you run out of $41,000. So that's the first part, is to replenish your allowance account. The second part of the entry is to record for this year the amount of new credit sales you think will go bad. Okay, so what this the bad debt expense is, that bad debt expense, remember expenses are only for this year. That bad debt expense pertains to new credit sales, which you think you will not collect. Credit sales this year, which you don't think you're going to collect. So if you sold $100,000 this year and you didn't think you were going to collect 2,000 of those, you would have $2,000 in bad debt expense. Okay, now keep these 3 entries in mind, keep them in mind, and also keep this in mind here. A presentation of accounts receivable, which was based on the first sheet here. Keep all of this in mind. Keep this aging here in mind with accounts owed of $1,010,000 and uncollectible amounts of $41,000. And keep this in mind, which is really based on the aging. The aging is saying you have $1,010,000 less $41,000, or $969,000 of a net realizable value of accounts receivable. Okay, these are the 2 things, these are the 2 items that we're going to base our example on. Okay, so let's go to our example now. Okay, so here's the last worksheet, which is the example. Okay, the example is based on the previous data. Okay, so the previous data is all right here. This is the exact aging that I had. If you go back here, that's the exact aging I had there. And the accounts receivable is the exact same accounts receivable I have there. So the beginning of year aging is from the first sheet here. I didn't link it. I linked everything else. And the balance sheet example is from that date also. So I'm going to say, if I recall, these are both as of both the aging and account and the balance sheet. So both this aging and the balance sheet are as of January 1, 2020. Okay, so we're starting at the beginning of this year. I wish it had been a better year, but we'll see what happens to the world, quite honestly. Okay, so let's go down here. And I said that you have 3 types of entries to, let's say you have 3 types of entries to these accounts. And those 3 types of entries, just to review, are credit sales, which are typical credit sales, happen every day of the year probably. Account write-offs, which you're going to debit allowance for doubtful accounts and credit accounts receivable. This entry will reduce both accounts receivable and the allowance. And finally, only one time during the year, we're going to make an adjusting entry that replenishes our allowance account because it keeps getting smaller with each write-off, and which also records the expense on new credit sales for this year, the expense of which represents the amount of the portion of new credit sales that we want to collect. That's the best way to put it. Okay, so let's go back to the example. And in this example, we start with the aging that you've seen for a couple times now and the corresponding balance sheet. Okay, so notice that, let's see here. Let's see. This number here is equal to that number right there. And this number here, with any luck, is equal to that number right there. So in a sense, the balance sheet numbers come from what we would call underlying records or subsidiary records. And notice if you go to this equation here, this equation, this is just a check number. This equation is account owed, that's your account receivable balance, less your amount uncollectible, and that gives you 969. That's the way it's recorded. This is the way it's recorded in your records. That's the way it's recorded in your records. And this is the way here that it is reported on your balance sheet. But they should both always equal. Your subsidiary records should always equal the amount that you report. There's a difference between recording and reporting. Recording in your records, reporting is when you release it to the public. Okay, now, I said before that there's three types of entries. There's three types of entries that go into these accounts. Number one are credit sales. Number two are account write-offs. And number three is the 1 year, the once in a year, end of year adjusting entry. Okay, so here we've got an example. We're starting right here. And here we've got an example of customer A. And you're going to have to go back and forth a little bit on the video, I think, because I've got some long T accounts here. Okay, so what I've got here is your balance sheet. And this balance sheet is exactly this balance sheet here. Okay, and I'm also showing you the T accounts. The T accounts, and just to show you ahead a little bit, and you can scroll down when you get the thing, is these T accounts are a little long. Okay, there's four or five entries in each one. But I want you to notice that the T account balance as of, I'll just say 1/1/20, the account balances as of 1/1/20 are the same. A debit balance in account receivable of $1,010,000 and a credit balance in the allowance account of $41,000. So that's where we're starting. Everything has $1,010,000 in it. There you go. Here's how it's reported. And I'm just giving you a balance sheet because I'm going to relate the balance sheet presentation to what happens to the accounts. And there's a couple of very important subtleties here. Okay, so let's go ahead and make our first assumption, make our first entry. Let's assume that customer A, that you sell something on credit to customer A. And let's assume that is for $20,000. The entry you would make would be you debit accounts receivable and credit revenue. That's supposed to be a credit there. Credit revenue for $20,000. So let's go ahead and do that. There's your credit. Okay. And that, first of all, this is just your regular entry. That's just your regular accounts receivable entry. Notice what has happened. Notice that the only impact this entry has is it impacts accounts receivable because there was a debit to accounts receivable for $20,000, and notice that the entry has impacted accounts receivable by has increased accounts receivable by $20,000. Now I'll go ahead and just look at this formula here. That new balance in accounts receivable, is this initial balance. This is from a presentation perspective, from a reporting perspective, plus that 20 gives you your new accounts receivable balance of $1,030,000. It's simply $1,010,000 plus 20 gives you your new account receivable balance, okay, which is $1,030,000. Now, let's see what we got here. Now, from a T account perspective, this debit from entry 1, we're calling that entry 1, this debit is posted to the accounts receivable account. That debit is posted to the accounts receivable account, and that will give you in the records a new balance in accounts receivable of $30,000. So this entry right here is posted right there, and the new balance in the account is simply your original balance of $1,010,000 plus your debit to accounts receivable, your credit sale of $20,000 to give you $1,030,000. Now notice that the $1,030,000 is equal to what you're presenting on your balance sheet right there. But notice something. There was no entry to allowance. When you make a credit sale, you debit accounts receivable and credit the revenue account. There's no entry to the allowance account. So the allowance, here's a one rule. After you make a credit sale, the allowance does not change. We started with, by the way, this should be, I don't know why I have revenue, that should be allowance. Just have to accept that mistake there, but that should be the allowance count. You'll notice that the allowance there does not change. Okay, so rule number 1, we've got a couple of rules here, is that rule number 1 is that after a credit sale, the allowance does not change. The accounts receivable changes, in this case by $20,000. It went up by this $20,000 right here, started here, it went up, so you add it, posted it, and ended up at $1,030,000. So the receivables went up, but the allowance stayed the same. Okay, now that's kind of an important rule. When you make a credit sale, your receivable goes up because you made a credit sale, but your allowance, you don't touch your allowance. There's no debit or credit there to the allowance account. Okay, so here is a very important point about this. Whenever you make a credit sale, it's basically the same point, but from a different view. Whenever you make a credit sale, while your allowance does not change, the net realizable value of your accounts receivable changes. Notice that we started at $969. That's the amount that we initially reported on the balance sheet. And we came down and we ended up with a new realizable value, $20,000 more of $989. And if you go out here from a T account perspective, I'll show you what I'm doing here. I'm just taking the new balances in each of the accounts. After this first entry, your accounts receivable went up by 20. There was 0 adjustment to your allowance count. So your new net realizable value is $989. That will be true both on the balance sheet and in your accounting records. Okay, now I don't want to beat a dead horse here, but I'm going to go down here. And just to look at this again, now we have a credit sale to customer B. Now we have a credit sale to customer B. Okay, and let's assume the credit sale to customer B is for $10,000. So this is going to be for $10,000. That's our credit sale for customer B. Now I want you to notice that the same thing has happened. Number 1 is, since we sold customer B $10,000 worth of merchandise, my line is a bit off here, but I think it will be able to follow me. Okay, since we sold customer B $10,000 of merchandise, our accounts receivable went from $1,030,000 up by 10 to $1,040,000. So once again, when you have a credit sale, your accounts receivable changes. There's no entry to the allowance account. So once again, the allowance account stayed the same. I'm just repeating my same point again. You have a credit sale, your accounts receivable goes up. It went up by 10,000 in this case. There it is right there. It went up by 10,000. Okay, but the allowance did not change. The allowance stayed the same because after this entry right here, after entry 2, there was no entry to the allowance account. So the allowance account has stayed the same all through this process right here. It has stayed the same all through this process. So far, we've had 2 credit sales, one for 20,000, which increased our accounts receivable by that 20,000. And then we had another credit sale for 10,000, which increased our accounts receivable by that 10,000. Okay, and this line is off here. I should bring these two down here. I should bring these two down a line, down a row there, but I don't know why. But anyway, but the lesson stays the same, is that our receivable balance in the T accounts, is the previous 1,030,000 plus this debit right here, which came, by the way, this debit here came from that entry right there. It's entry number 2. Okay, and so we have what we have here is our accounts receivable are $10,000 higher. Our allowance is still the $41,000 it was before. So the rules stay the same. When you have a credit sale, your accounts receivable goes up, your allowance stays the same. So as a result, your net realizable value will change because of the extra $10,000 that you added to accounts receivable. Okay, so you had $989 there, which was $1,030,000 minus 41 gives you $989. And your accounts receivable balance is your new balance. You added 10 to it, so you have $1,040,000 now. Your allowance stays the same, so your net realizable value is now $999,000. Is your new net realizable value. Okay, so notice from a T account perspective, I posted. So from a reporting perspective, this is your balance sheet. From a recording perspective, I posted that debit to that account receivable, and that account receivable right there is just the addition of the $10,000 to account receivable. Now notice once again, this entry here, entry 2 here, had no effect on the allowance. There's no entry there to the allowance account. So our rules stay the same, that in the T accounts, our rules stay the same, that our allowance doesn't change, which means that your net realizable value did change. So if you go there, that net realizable value of $999 is $10,000 higher, and that net realizable value, the previous net realizable value of $989. Okay, so those are the basic rules for credit sales. Whenever you have a credit sale, your accounts receivable will go up. Just use this as an example again. Your accounts receivable will go up, in this case by 10,000. Your allowance will stay the same, which means that your net realizable value will go up by $10,000 in this case. So whenever you have a credit sale, account receivable goes up by the amount of the credit sale, allowance stays the same, so your net realizable value will change by the amount of the credit sale also. Because one number changes, the account receivable changes, but the other account does not. Okay, now let's go to the next 2 types of entries. These will be a little bit different. Keep in mind that this account here is accounts receivable. Maybe I should have rolled it up. I'm not sure I can do that. And this is your allowance for doubtful accounts. Okay, but you can always go back and forth in the video. Okay, now here are 2 write-off entries. And keep in mind that this line is the debit side for accounts receivable and the credit side, and the same here too. Let me see if no, that wouldn't work. Anyway, let's go to write-offs. Okay, now let's go. Remember that customers A and B had fairly decent credit records. B not so much, but good enough. Customers A and B had fairly decent records. But Customer C tends to be a little bit of a freeloader. Okay, so what we're going to do for customer C is we're going to assume for customer C that customer C decides not to pay. They decide not to pay. Of the $400,000 they owe, they call up and they say there's a couple of amounts they don't want to pay, and they're just not going to pay. So you say, you just write you know this person, you know they're not going to pay. Your lawyer probably charged you too much, so you're just going to go ahead and write their account off. Okay, so here's the entry that you always use to write off an account. And it's very important that we keep track of these accounts. Okay, remember that before this write-off, we have a balance in accounts receivable of $1,040,000, an allowance balance of 41. Here they are right here, and a net realizable value of $999,000. There it is right there. Okay. Now, the rules for writing off, the entry to write off customers, and I'm going to assume 2 write-offs for customer C. I'm going to assume 2 write-offs just to get the point across. There's 2 rules, or 1 rule. Let's do the entry, then I'll give you the 2 rules. Okay, let's assume that the first debt that customer C doesn't want to pay is equal to $5,000. Okay, so customer C calls you up and they say, we're gonna, of the total 400, whatever we owe, what is it they owe? They owe 400,000. Of the 400,000 they owe, they're not going to pay $5,000. So you have to make an entry. You have to make an entry which does the following, which debits the allowance account for $5,000 and credits the account receivable. Now, here's the 2 effects. The first effect is a very important one. The first effect is that you're going to take the $1,040,000, you're going to take that $5,000 out of accounts receivable, and you're going to end up with $1,035,000. So by writing off an account, your accounts receivable goes down by $5,000 here from $140 by $5,000 to $1,035. Okay, and that's appropriate because you cannot claim that somebody, as an account receivable, you can't claim as an account receivable an amount that you know cannot be collected. That's the first thing. That's the obvious part. When you can't collect it, you got to take it out of account receivable. The other thing you have to do is you're going to debit the allowance account. And notice that unlike credit sales, in this case, the allowance account actually goes down. Keep in mind, the allowance account has up to now has had a credit balance of 41, 41, and 41. It hasn't changed, but now it changes. Okay, and what's going on here is that before this account was written off, you had said, well, we believe that $41,000 of accounts will be written off, will not be collected. This is now being realized. Your worst nightmare is being realized that this person, I'll say guy, is not going to pay. So your allowance is going to go down by $5,000 to $36,000. So you estimated this amount would not be collected. Now that it hasn't been collected, you've got to reduce the amount of your estimate that relates to future uncollectible amounts. That $41,000 was the future uncollectible amounts back at the time of entry 2. Now that $5,000 has not been collected, and I'll go ahead and point to the entries here. Okay, now that $5,000 hasn't been collected, your estimate is $36,000. That's the first rule of when you write off a customer account. The first rule is you have to write off the allowance for doubtful accounts, which will reduce that allowance. Now, here's the second rule, and it is also important. Notice what you've done. You've got accounts receivable here you originally had $1,040,000 less 41 gave you 999. Then you write off an account, but the write off the account takes $5,000 both out of accounts receivable and the allowance account. Here's the allowance account. So here's the second rule. Whenever you write off an account, the net realizable value, RNV, net realizable value of accounts receivable doesn't change. Notice that it did change up here for credit sales, but when you write off an account, it doesn't change. And the reason it doesn't change is because you're taking the same amount out of both the allowance for doubtful accounts and accounts receivable. So that's kind of an important rule, is your allowance is going down. It's going to need to be replenished sooner or later. So your allowance is going down, okay? And then that it's going to need to be replenished. That's going to be our adjusting entry. But the basic rule for write-offs is debit the allowance, credit accounts receivable. The same amounts come out of both. So the net amount, when you net the two, it doesn't change. The net realizable value stayed the same. And that goes true. It's also true for the T account representation. The T accounts I'm just putting over here. One is, these are just different views. This is a reporting view here, and this is a recording view here. So if you go over to the T accounts, this is your accounts receivable T account, you'll notice that this accounts receivable, you had a balance of $1,040,000. You took 5 out with that credit right there where my pointer is, and you end up with a balance of 135, which is equal to 1035, which is equal to that, which is equal to the reported amount. And then your allowance account will go over here. Your allowance account started with 41. You took 5 out, so you end up with 36, which is equal to the amount that's being reported in the allowance account. And then finally, your net realizable value is just in the T accounts. It's the 1035 balance, which is equal to the amount reported. You could actually say that in reverse, but that's okay. And the 36, which is equal to the allowance amount reported. So on your balance sheet, you're showing this balance here of 1035 in your T account. Your allowance balance is 36. After the write-off, the net realizable value does not change since you took 5 out of each account. And this 999 is equal to that 999 right there. Okay. We're going to do one more write-off, then we're going to get to our year-end adjusting entry. Okay, so one more write-off. Once again, I'm assuming that customer C is a bit of a schlock and is not going to pay. Okay, so for customer C, we're going to have allowance for doubtful accounts is equal to, let's say they're not going to pay an account for $6,000. First of all, they were neging an account for $5,000. Now they're going to renege on an account for $6,000. Okay, so here's what we got. Okay, we've got the same basic result as before, the same basic ideas. I'm just doing it a second time to emphasize this. Okay, so what has happened is we've taken 6 out of the allowance for doubtful accounts out, and we've taken 6 out of accounts receivable. Your new accounts receivable balance, is, clicking this here, is your previous 1035 less that 6,000. So you now have 1029. Your new allowance balance is 36,000 minus 6,000, or 30,000. So you took 6,000 out of each one of these things, and your you took 6,000 out of each one of these things. So your net realizable value doesn't change. I just did this second example to emphasize that, once again, when you write off a customer account, it can happen anytime when a customer won't pay and your net realizable value doesn't change. So you can also go to the T accounts over here, and we can highlight this in red. And once again, what we did in this T account here is our new accounts receivable balance is 135,000 less this 6,000, which is that 6,000 which was posted. So our new accounts receivable balance is 1029. We come over here to the allowance account, and the new allowance account balance is 30,000, which is your 36,000 less your 6,000, which gives you a balance of 30,000. And once again, your entries will not impact the net realizable value. You start at 1035, you took 6 out, and for your accounts receivable, and you ended up with 129 here. That's your new balance, which is also shown right here. And then for the allowance account, you started with 36, took out 6, and you ended up with a net realizable value of 999. This is the reporting, what you'd show on your balance sheet, and this is the way that it would appear in the records. Okay, now for the hardest part. The hardest part is your year-end adjusting entry. And your year-end adjusting entry, I'm going to call it entry 5 here. Your year-end adjusting entry, I'm going to put a little asterisk here, a little star. Here is your year-end adjusting entry. Your year-end adjusting entry, and I'll put a little star here. I'm going to say based on new aging. Okay, your year-end adjusting entry is going to be based on your new aging, which I'm putting out. I can't do that, but it's the aging which you see to the right there. This is our new aging. Now, there's a lot of things that could have changed about this aging. I'm going to go ahead, sort of take this out here. It's the same aging as before. It's the same aging as up here. However, two things can change about an aging as you go through the year. The first thing is these percentages here can change. So those percentages there, it's possible that you've gone back and re-looked at all the credit ratings and credit experience of all these customers, and you might actually change these, and in most cases, you're going to raise those uncollectible percentages. So your aging amounts, your estimated percentages of uncollectible amounts could change, and that would change the bottom number of your new aging. Okay, that would change the bottom line number. That would change that 409 for 40,950. Okay, and keep in mind that we started at 41,000. So the other thing that can change with an aging, the second thing that can change with an aging are, and so I'm going to assume that these stay the same. Notice I'm assuming that those numbers there, 1, 3, 5, and 50% stay the same. Those might have changed. So I've decided that we don't think our customers' creditworthiness has changed at all. But the next thing that obviously changes is in an aging is the amounts owed at the end of the year. So here's what we got. You'll notice that this number here, I'm going to have to go up, is B8 plus B6. And that's why I'm sending you the worksheet. You're going to go back to the worksheet, or you can look at the video. You can go back and forth on the video. But customer A, that has changed because customer A originally owed $1 million. However, we had a credit sale to customer A for $20,000. So this is cell B8, that's cell B16. So customer A now owes us, there it is, B8 plus B16. Customer A now owes us $120,000. So that will increase, the 1% stay the same, that'll increase my estimate of the future amount that's uncollectible. Okay, now customer B, you'll notice that customer B originally owed us $500,000, and we had a credit sale to customer B of $10,000. So customer B now owes us $510,000. Notice that the equation for this, it's way up there, but notice the equation for customer B is B29 plus B21. Notice that B9 is $500,000, B21 is $10,000. So customer B now owes us $510,000. and $10,000, which are the amounts up there. It's $500,000 plus 10,000, which taken times the same percentage, 3%, is also going to change the amount that we deem to be uncollectible in the future. Okay, now customer C, I left customer D alone. I've just left customer D alone because they're probably just forgetting about them. They're so pathetic. Okay, but customer C, for customer C, we didn't sell customer C anything new, but keep in mind, we'll look up here. Notice that customer C is the amount owed. You're going to see it's the amount owed less the 2 write-offs, because they owed us originally $400,000. They originally owed us $400,000. We wrote off $5,000 for this, $6,000 for that. So the new amount is they owe us $389. I'm going to go back and show you. Customer C originally owed $400,000 of accounts receivable right there. But then we wrote off $5,000 there and $6,000 right there. So customer C now owes us $400,000 minus 11, or those two, that equation right there. It's $400,000 minus write-off of 6, 5 minus write-off of 6 gives you $389,000. Take that times the percentage, and you get $19,450 right there. $19,450. Okay, and then customer D, I've just left alone. So given that the percentages stay the same, but that we sold more to customers A and B and wrote off some accounts for customer C, this new aging is telling us, this tells us what your new allowance balance should be. So this aging right here, the number right there, that's the all-important number. I'm going to put it in red. This is telling us, after these 4 or 5 transactions, what our new allowance balance should be. So whatever we do, we have to make an adjusting entry. And the adjusting entry we make must result in an allowance balance which is $40,950. Okay, so here's what the adjusting entry is. The adjusting entry is it's equal to G45, which is that number right there. That's what our allowance balance should be. Less, go back here. Well, actually, I think we can actually point to these things. It is G45, which was what our allowance balance should be, less what we had in our allowance balance going in to entry 5, going into the end of the year, $30,000. So our new aging says, well, you should have $40,950 in there going into the end of the year, because you've written $11,000 out of this thing. You only have $30,000 in there. So if you take $40,950 less that $30,000, that's going to give you your needed adjustment of $10,950. Okay, so what we're going to do to finish this video here, and you should keep taking a look at that right there, because everything here has been a result of sales or write-offs. You come to the end of the year and you can change these numbers. These numbers will change. The amounts owed will change because you're going to have credit, sales, and write-offs. Those amounts will change. We assume no change here. Those amounts owed did change. So, but whatever happens, this number here is key. This is where our allowance balance should be. Okay, so we need an adjustment to the allowance of this entry. We need an adjustment to the allowance of $40,950 less the existing balance of $30,000. So we're going to need an adjustment in there for $10,950, which once again is the difference between these two amounts right there. Okay, so the final thing I'm going to do in this video, and I'm going to do it manually because there's circular logic, and I don't want to mess this up, but I'm going to call this entry number 5 here. I'm going to call this entry number 5, which is your year-end adjusting entry. There's entry number 5. Okay, so we'll just put it right in there. You can actually take it up and put it right there. Entry number 5, we'll make it consistent here. Entry number 5 is your year-end adjusting entry. Here's what it is. You have a debit to bad debt expense, which goes off to the income statement. Actually, I'll just move it down here. I hate to keep doing this. Okay, so this goes off to the income statement. We're not worried about that one. The one we're worried about is that one. So from entry number 5, there is 0 entry to account receivable. Keep in mind, this is your account receivable T account right here. There's 0 entry to account receivable, but there is a credit here to the allowance account for $10,950. So we're going to have a credit to the allowance account for $10,950 right here from entry number 5. We're going to do this $10,950. So our new balance, our ending balance here, and I'll put balance here too. Our new balance in accounts receivable is $1,029,000 plus 0 gives you that amount right there, $1,029,000, but which, by the way, is equal to the account receivable balance in the aging. This is your account receivable balance right there. Okay, and our allowance for uncollectible accounts balance, and I'll underline this, our final allowance for uncollectible accounts balance is going to be that $30,000 plus this credit here to your allowance balance. Get this right here. Our new balance will be, I'm just going to move this up very quickly. It's going to move this up quickly here and move this up very quickly here just to get these more balanced. It doesn't matter. Put it down here. So our new balance and the allowance balance is going to be that amount right there, assuming I'm not getting circular logic, plus that amount right there. Our new balance and the allowance balance is going to be $40,950, which equals what our aging said. The key number in all this is that right there, is this number right there. You get a new aging, subtract out the 30, that's going to give you the amount of your adjustment right there. When you add your adjustment right there, it will give you your new, it will give you an allowance balance which equals the amount indicated in the allowance in the aging. And now finally, let's do this. Your new net realizable value, in the T accounts is going to be equal to your account receivable balance less your allowance balance, which is 98805. And I'm going to go ahead and recreate this. So your new allowance balance, your new amount on your balance sheet is going to be equal to your account receivable balance is equal to $1,029,000. Your allowance balance is going to be equal to, I'm putting a negative. The negative is really represented by the credit, $40,950. So the sum of these two is going to be equal to 98805, which is equal to the net of the two in your T accounts, and it's also equal to the net of the two in your aging, the 1029 less the 40950. Anyway, I hope this has helped. It's probably a little longer than I thought, and sometimes my voice on this computer doesn't come out too well because it has a built-in microphone. And there's still no way to hook in an external one, but I think this should help you. So anyway, everybody take care of themselves. A month ago, everything seemed normal. That's not the case anymore, so please take care of yourselves. Anyway, if you have any questions in the next few days, I'm going to be emailing you. I'm going to upload this tonight, and I'm going to email you regarding ways you can contact me. Anyway, very good night, and please, everybody, take care of themselves. Thank you very much.